I want to thank you all for joining us this morning. My name is Steve McMenamin, and I'd like to welcome you to today's event, which is part of the continuing series of the Greenwich Roundtable. Our topic this morning, Complexity Reform and the Future of Finance, is our first collaboration with the CFA Institute and a continuation of their series on the ethical and practical dimensions of the asset management business going forward. Our speakers are two of the most important people that will shape the road ahead. Both are longtime friends of the Roundtable, and I'll briefly introduce them after I say this. The speakers' views are their own and don't necessarily represent the views of the Roundtable, its staff, or any of the members. So having said that, I would like to introduce Bob Steele. Robert Steele is an old friend of the Roundtable, as I've said, with significant experience in both public and private sectors. Mr. Steele is the chief executive of Perella Weinberg Partners, a $9 billion assets under management asset management firm based in New York City. Before that, he was New York's deputy mayor for economic development under Mike Bloomberg. Before that, he was the chief executive of Wachovia, where he was brought in to save that firm during the crisis. Before that, he was the undersecretary for domestic finance at Treasury, where he battled the crisis with Hank Paulson in 2008. We know we were in his office the day the markets broke. And before that, Bob spent 30 years at Goldman Sachs, rising to head of global equities and serving as vice chairman. Bob is the chairman of the Aspen Institute, past chairman of Duke's board, chairman of the After School Corporation, and a generous local philanthropist. Sitting to Bob's right, your left, Lawrence Fink is the chief executive of BlackRock, an asset management firm he founded in 1988 and based in New York. Mr. Fink is frequently sought after by government leaders and policymakers for advice on navigating the increasingly complex financial markets. His leadership style could be described as client-centric with a focus on innovation. The market seems to agree with that style, as it's entrusted BlackRock with over $1.3 trillion in assets under management. I hope I got that number right.
No, you're wrong.
Uh-oh. Oh my gosh. He's also been named the world's best CEO by Barron's for 8 consecutive years. Before that, Larry was one of the first mortgage-backed traders on the street at the old First Boston, and rising to the management committee of that firm as well as running its taxable fixed income division. Mr. Fink is a trustee of NYU, co-chair of the Langone Medical Center and the Partnership for New York City, and a member of the board of MoMA, the Council of Foreign Relations, and Robin Hood. Larry, perhaps unbeknownst to him, is also an old friend of the Roundtable. And the moderator of today's Roundtable is Kurt Schacht, a managing director of the CFA Institute in New York, where he runs the Institute's professional standards, industry ethics, and governmental relations practice. Kurt is chairman of the Investor Advisory Committee for the SEC and a member of our programming committee. Please welcome Kurt as he sets the table for today's discussion. Kurt?
Good morning, everybody. Enjoy your breakfast. We're very glad to have you here this morning. As Steve mentioned, I'm from the CFA Institute. That's the Chartered Financial Analyst Group, if you're not familiar with those initials. We have 130,000 global members now around the world in 144 different countries. We have another 230,000, I'll call them kids because they're people in their late 20s, early 30s taking this exam on a global basis. So almost 250,000 additional people in our program on a global basis. It is a particularly hot commodity in China. We have 30,000 kids in China that are signed up to take the various 3 levels of the CFA exam in China. So I think they all want to become hedge fund managers and drive Ferraris. Seriously, the entire focus of the CFA exam and our programs and the work that my area is engaged in is to try to help shape a better, more ethical, more client-focused future of finance generally, and most specifically the investment management industry. I think we had a little reminder this week and last week of what it means to be scared by markets again. I remember how I felt back 5 years ago now. It still seems pretty painful when the types of disruptions that we're seeing happen. What that did 5 years ago in terms of the perception of trust in this industry, what it did and how it resulted in the regulatory response to the crisis, the client fear issue, the whole paralysis of markets that resulted from the crisis, and I think very importantly what it did to people's retirement security are still issues that are very strongly felt today. So we have been doing a range of things. CFA has been doing a range of things designed to examine these issues, like this forum today. We've been doing future of finance discussions around the world for the last 6 or 7 months. We have been creating thought leadership best practices like our Asset Manager Code of Professional Conduct, which Larry's firm BlackRock has just adopted here in the last 3 weeks. The largest investment management firm in the world has adopted this Asset Manager Code of Professional Conduct. We have so we've been doing best practices like that. It's a wonderful, wonderful companion to the best practices that the Greenwich Roundtable has put together for you investors in terms of how you invest in alternatives. So it's a perfect complement for that. We're, as Steve mentioned, we're serving on key regulatory committees, advisory groups like the SEC's advisory committee, all in the hope and the goal of making sure that practitioners are more ethical, that they're more engaged with professional standards, and that the rules are more investor focused. Just maybe restoring a little bit of the trust lost along the way. Weeks like this make it tough, though. So given what's happened these past few days, how fortunate are we to have 2 of these just extraordinary market veterans with us this morning to help us feel a little bit more informed about what the future of this industry is going to be, what the challenges and opportunities of this industry are longer term, and maybe a few calming observations on where we are amidst what has become this legendary October turmoil that I think we're getting used to. So thank you both, Larry Fink and Bob Steele, for being with us today. Let me just start off with a question on our topic of the conference today, the future of finance. There has been, as you all know, a very dramatic change in the financial services industry since the financial crisis, both in terms of the regulatory framework as well as other market factors. So how do you 2 see this continuing to play out over the course of the next few years? Have we fixed the things that we needed to fix? Are we sort of back on steady ground? And how has this process impacted your ability to serve the needs of your clients?
I think we need to address how we got here and the response of the world. There were some very bad behaviors in the financial system. And importantly, the system grew faster than the regulatory structure. And we had some very, very bad governmental policy that got us into this financial crisis. We should predict that we will have future bad governmental policy. So have we fixed all the problems? Probably not. Nevertheless, the government has determined that leverage is a bad thing, and leverage within deposit gathering institutions that have insurance from the government. The government needs to be protected. And so they have deemed that we had inadequate capital, which is probably true. 2, we needed to focus on things like liquidity and other measurements of risk. And so by and large, the U.S. has done a great job in terms of reconstructing our banking system. I think our banking system is in far better shape than Europe today. Europe has been lying for the last 5 years, and on October 27th, Europe will finally announce the results of their 3rd stress test, because the last 2 of them they lied. And so we'll see where that ends up going. So our banks are in better shape. And as a result of higher capital standards, banks have not served society as well as they used to. If you believe that banks were providing more loans to more people in society, by definition today, many, many loans are just unprofitable today with 10% capital versus 5% capital. In addition, regulators, and this is a confusion between the regulator and the supervisory people, I don't think they are working together. They have demanded and enforced higher scoring and or higher credit standards. So as a result of banks not serving society as well, which is, I think, a societal request as a result of having higher capital and other standards, much of the activities have moved to the capital markets. Some people call this shadow banking, which is, from my perspective, is a government regulator wishing to regulate more. We do have the SEC already regulating, theoretically, this. The problem is the SEC does not regulate what we call macroprudential risk, and so this is where all the confusion lies. And so the capital markets have been filling in some voids, whether it's a business development corporation, even a hedge fund or a private equity firm who is lending, or an asset manager. And so we're going to have to determine now how we regulate the system to making sure that the system is working. So they created this committee called the FSOC, which is another good example of how government really does not serve the people as well as you would like it to. It took them 4 years to determine that maybe scale of one asset manager is not the appropriate way of looking at future regulation of asset managers, but it might be activities. We've been telling them that for 4 or 5 years. So if you think about the ecosystem of the banking system, if you regulate the top 8 banks, you really have 80% of the deposits in America. Right now, they're trying to regulate the 3 insurance companies because they deem those guys are systemically risky. Well, those 3 insurance companies represent less than 12% of the ecosystem of insurance companies. You don't change anything in insurance risk. You just move it from those 3 companies to other firms. So I think they're going to have to relook at how they're going to regulate the insurance industry. And then the asset manager, there was a lot of commentary about 3 or 4 firms who deemed to be SIFIs, and that would be representing less than 8% of the capital markets. And so you don't accomplish what they were thinking of doing. And so now they're looking at activities. And I think, Kurt, the actions in the last 10 days, and certainly yesterday and this morning, and I had a long conversation with Secretary Liu last night about the activities. I do believe the actions the last 2 days are entirely leveraged positions from hedge funds and other sources being wrung out. Obviously, long-only managers resizing their positions. And so to answer your question, are we finished in reviewing and making the system safer? No, I think the last 2 days of activities showing there's still way too much leverage in the system. There is a large-scale amount of irresponsible investing. Short-termism is growing dramatically. We're doing nothing about it. And so I actually believe the FSOC, the Financial Stability Board, because of the actions in the last week, the world feels awful today. I promise you the world growth has not fallen off a cliff in the last 5 days. But the actions certainly feel like we fell off a cliff over the last few days. And this is just an example that we still have an unsafe system. We have many players who are exhibiting really unusual behaviors in terms of heavily leveraged. You could leverage 50 to 100 to 1 in the short end of the Treasury curve or the Euro curve. And if you looked at the Euro-dollar contract yesterday, you had the highest volatility in the Euro-dollar contract yesterday than any time, even in 08 and 09. That was just some bad-sized leveraged positions. So no, we still have unsafe practices, and we still have a system that needs to be reviewed, and I think it's going to be reviewed by activities. But if somebody asked me, are banks going to be the next crisis, and I would say absolutely not. I'll just leave it there, let Bob carry on, and I'll have some yogurt.
So I don't think I have. First of all, Steve, congratulations to you, and thanks for having us. I think Larry said a lot of things I would comment on. Let me try to take it a little bit differently. I think that coming out of the 08 crisis, that we had a response politically and from a regulatory perspective. And to my mind, the response was 1/3 financial services regulation, 1/3 consumer advocacy, and 1/3 retribution. And really, that's the reality. And that might seem cute, but you have to accept that is the truth. And that third part of retribution is a big part of what's in the political system today. And the question was, going forward, what's going to change? And I think that that this feeling of need of the people to check large financial institutions is not through. I think the only issue that the far right and the far left agree on, that you could get Jeb Hensarling and Elizabeth Warren to agree on, is that they don't like large financial institutions, and one would like to break them up, and the other would like to have much more regulation and a much stronger consumer advocacy point of view, but neither are in favor of them prospering, and none of them care two bits about the rate of return on capital at large financial services institutions. And I can't think of 5 other things where these two cohorts agree in such a strong way. I think that when you frame this, that the odds are high that it will be a struggle for large financial institutions to earn attractive returns. And this, I care about this not just because of the financial institutions, because I think it has what Larry said, is it has a leveraged effect where it's not providing capital in efficient ways to the economy. So that's the side effect of this that's actually more important to me. Recessions and unattractive events are quite regressive. They hurt poor people much more than they do us. And I think the reality is the slow growth and the way in which you're responding has been very, very mean-spirited in terms of how it's affected those types of our citizens. I think there's also the result, which you have to accept, whether you like it or not, that the decision to basically set a new unprecedented term structure of interest rates also exacerbates this same thing. Those of us with assets are getting them remarked because of the attractive discount rate that this Fed policy is generating. So there's another aspect that generates this idea of mean-spiritedness, antagonism, you choose your word, but I think that's not going to change in the next 2, 4, 6 years. Dodd-Frank is 60% done now or implemented, so there's a lot of work still to do. I actually think the idea, and we proposed this when I worked for Secretary Paulson, of an FSOC-like entity is a positive. That's not believed by everybody. Really smart people, we were shopping this idea when we worked at Treasury, and really smart people didn't like it and thought that it would not work, and that you never can kind of know when to lean left when everyone else is leaning right, that it's just too hard, and that the market is the right correcting mechanism. That was the view Alan Greenspan gave to us when we went to talk to him about it. I don't agree. I think having some type of connected oversight, while it might not be perfect, is better than none, especially given the patchwork of regulation that we have. Larry said this, I could go on, and we worked on it at Treasury, but the nature, our regulatory system is a very, very unproductive with regard to either regulating or encouraging the economy to grow. It's 0 for 2. And someone is going to have to throw a big stick of dynamite and try to kind of compress this and make it more efficient. It's not about more or less regulation. It's about regulation that works. And that's really the spirit in which we've thought about it.
Let me ask you just one real quick follow-up on this, because CFA Institute has put together something called the Systemic Risk Council. It's a private sector council. It's chaired by Sheila Bair, the former FDIC chairperson, Paul Volcker. There's a bunch of people that are on this group. And in terms of the issue of fixing what needs to get fixed, they're still of the view that these institutions are too big to fail, too big to regulate, that we haven't made much progress on that very important systemic step. What do you think about that?
I'll take a swing, but I think the reality is that I don't really like the vocabulary, to be honest. I think it simplifies something. It tries to simplify something. It's really quite complex. The issue we have to figure out is we have depository institutions that have a special place in our system. They're not like other industries. They basically are really the system that allows the economy to grow. And we have to be careful to protect them so that they don't have a systemic effect. And I think that boosting the capital is okay with me. I'm okay with that. I think it's hard to figure out exactly how you do it. I don't particularly like the idea of proscribing their activities. I think that's hard, and it's rules-based. And rules-based behavior, I like principles better than rules generally. And rules-based behavior just encourages you to figure out a way to get around the rule. And then you end up with the same condition, just presented in a different way. So my own view is bumping capital, not overly prescribing the business activities, is a better way to go. I don't think you'll ever eliminate the potential for firms to fail, and what you want them to do is have a process by which they can be wound down in a slow, it's like when the plane has a problem. You want to figure out a way to glide in for a landing, whether it's in a field or on a road or whatever. And
hopefully an airport.
Exactly. Well, hopefully. But if it's an unattractive situation, you just want to get a good place to land. And so I think that the idea of you're never going to solve it completely where there's an elegant way, where there's a road off the highway to get off, and it's going to be messy and things like that. So I think the idea that we're going to have a simple solution, and we all would have the view that equity holders should be crushed, if not eliminated, and there should be some penalty to some debt holders, and then you work down the cascade. But I think the idea, let me just finish with this one point, this is taking too long. I think the idea that there's a single solution and all of a sudden you'll have too big to fail solved and you can do this, I don't believe it. And so I think it's a wrong image for what to accomplish.
I think the biggest problem we have is regulators like optionality, and they're so opaque in how they resolve. They do not want to have a systematized process. And it doesn't mean it has to be a process that fits all, but they don't have a process. And so the regulators in the United States are talking about a living will. How do you unwind a company? And I raise a question continuously to Sheila and other people. Why do you focus on deaths? There's a very clean and simple way of resolving a resolution process, and it will make banks a lot safer, but it may have more negative impacts on the economy because they're going to be less risky. And that is, I believe regulators should have a process in which if there is capital decay because of bad business practices or bad market making, they have a 90-day period to restore that capital base in common equity. Pretty clean, no different than anything else. If you're supposed to have a 10% common capital charge and you have bad practices, you lost 0.5%, you have 90 days to restore that in common equity, not a COCO, not anything else. I promise you business behaviors would be quite different. More importantly, we would not have to be worrying about living wills. And you could give the optionality to the regulators, saying if there's something that's really systemic that the whole banking system has eroded capital, you could defer that period of time for a while. BlackRock is the largest shareholder of banks in the world, and we're the largest owner of subordinated debt of banks in the world. We believe that if there is a definable process of capital restoration, albeit stiff and harsh, like I said, a 90-day period of restoring that capital base, we believe practices within the banks would be probably better. And most certainly, if that knowledge base, banks would trade at a substantially higher PE. Banks trade at the lowest P's of any financial services types of companies because there's so much uncertainty. And we believe the uncertainty is because regulators are creating the uncertainty. And regulators love the optionality. They will not, they will not describe how you resolve an institution, and they're putting all the pressure on these institutions to create a living will. Which, okay, if you die, how do you resolve it? And once again, I can't understand how regulators are not focusing on using the market structure, to build, restore capital base.
The right analogy, I think, to pick off on what Larry said, is that we're spending too much time thinking about funerals and not thinking about how to improve your health when you get sick. And so I think there's a vocabulary issue, which I tried to describe, and to think otherwise.
Good. We'll talk a little bit more about the markets and geopolitical in just a second. But one of the biggest issues that has been discussed in terms of the future of finance is the issue of retirement security and all of the very important mega trends that are shaping the market today in terms of the changing demographics, increasing longevity, very poor planning and poor savings practices across the world. So just simply stated, do you see a way out of this? Is there a policy way out of this or an investment way out of this? And how big of a issue do you think it is?
This is one of the topics that I spend a great deal of time on. The crisis is now, let's be clear though, the reason why it's not a crisis in Washington, it is not a crisis in Washington. Every federal worker has a great retirement package. So they don't care. And that's one of the real flaws what's going on now. This is a private sector problem. It's not a public sector problem. Certainly in the federal workers, obviously it could be a state worker problem, or if you're a city in Detroit, it's a problem. But it's not a federal worker problem, and as a result, this is just being neglected. Now, Kurt, you talked about longevity, you talked about issues. The average American today, at the time of retirement, saves $18,000. That's it. The average American is now, 70% of the Americans today are dependent on Social Security as their sole means of having some financial abilities to live. Social Security, depending on the American, is anywhere from $16,000 to $24,000 a year. Social Security was designed as the third leg of a stool. You were supposed to have private savings. You were supposed to have savings from your corporation in the name of defined benefit plans. And those two other legs have been totally neglected. We are not prepared. Every time I speak at universities, I tell the kids, be prepared. Your parents are going to live with you because they're not going to have adequate savings, which is going to represent huge issues related to construction and GDP if we're going to have more and more components of our population sharing a dwelling. But most importantly, we are not doing anything to prepare for it. There should be some form of mandatory savings within the country. We should relook at Social Security. We should define what Social Security is. It is just an insurance policy. It is a very expensive insurance policy, by the way. We are contributing, I think, between personal contribution and corporate contribution, we're contributing 9%. If you just calculate how much money you personally contributed, you need to be 83 years old to get a zero return. A zero return. But it's meant obviously for an insurance policy. It is a, and that's all it is. But in Australia, they have a mandatory savings plan. They don't have a Social Security plan, and right now it's all corporations that are putting into some form of equity plan. Mandatory 9%. It's going to 12% in Australia, and Australia will be the third largest savings society in the world because of what they have done. We refuse to think about it and act about it. Obviously, if we don't change the concept of Social Security, if we don't raise the concept of mandatory savings, we are going to have, we are going to see the impact of inadequate savings towards retirement. And as Kurt, you said, you talked about longevity. So couple 60 years old in good health. One of the two of the couple will live to 92 years old today. And so you could raise a question, and this is one of the big issues in the demographics in the workforce. You could raise a question, why would anybody retire at 60 years old when you have a 30-year life left? Or you have a high probability if you had two working couple at 60 years old working. So it's an education process, and we are doing nothing about it federally. And I do believe companies will ultimately have class action suits because they're not adequately educating in terms of how people should be savings for the defined contribution plan. The biggest problem in defined contribution plans, when you are responsible for investing yourself, people are panicked. They see what's going on in the marketplaces today. And if you have a 30 to 40 year liability, why would you own cash or bonds when it's a 30 to 40 year liability? You should be 100% in equities or other forms of long-term opportunities to make a real return over a long period of time. And so we are not responding to human behavior. When we think about defined contribution plans, we're not educating related to human behavior. And as a result, human behavior is even creating and aggravating a further problem because the weakness in the defined contribution plan and advice.
I don't think I have much to add. I think Larry knows this area cold. I'd just make two comments off of things he made. You know, a recent study from Harvard, it looks over the 40 years from 65 to 05. During that period, the average life expectancy increased by 9 years, and the average time of work increased by 6 months. So basically, that's a disconnect. People should be working a lot longer, and so that just makes no sense at all. I think the second issue, my own policy perspective, is this should be something American corporations should take on. I think there's zero chance that could be high of the government proactively developing a positive policy on this. And I think that this should be a good issue that the chamber or someone like that should try to really develop a spirit of solution on this, because I think they're the best, they're the only likely adult in the room.
But they don't want the liability.
But I think that if you could figure out a way, they're my only hope. And so I don't have any hope from the federal government. So I guess I'm throwing a long pass because I don't like the alternative. So
it's amazing. The federal thrift plan, which the federal workers receive, is a fantastic plan for federal workers to get a retirement. It's mostly in equities. It's mostly in index equities. I think we're their largest manager. They do it well, and the men and women who work in the federal government have absolute security in terms of their retirement. And
but the political appointees did not get that program,
no.
Just by the way.
That's true. That's true. Political
so
appointees
Ken and
don't
I didn't get it, so anyway.
I think you got a good one at Goldman.
All right. All right, so let's go from no hope to heightened geopolitical tensions. I saw a man the other night at the Shell station. He was dressed in his Ebola hazmat suit. He had on his night vision goggles, and he was swiveling around looking for ISIS insurgents while he gorged on cheap New Jersey gasoline. So what global events are you most concerned about having an impact, either lasting or temporary, but what's really of concern to you on the geopolitical scale?
I'll offer one opinion. The litany, and I don't think my perspective's any better than yours, to be honest. I guess I'm not supposed to say that, but I think it's true. You can roll through all the various things. I think the tension and the offensive nature of the engagement of Russia with the Western world is the one that seems most problematic to me for the long term. And you could pick 10 others, but this is one where you have a well-armed person who thinks in a very different term. Someone once said to me last summer, I heard us talk, and someone described Putin as deranged or things like that. I think that's just 180 degrees wrong. He knows exactly what he's doing. He's playing a game that'll probably outrun 3 or 4 U.S. presidents and 8 or 10 secretaries of state and defense. And so he basically wants to make sure his western border stays a buffer or hospitable, doesn't slide to the west, and he's willing to do almost anything within reason and challenge us in ways we don't think he would do continually. So I think if you said what's the single most issue, that's the one for me, but you could have 4 others, but the question was which one.
Yeah, I don't have anything more to add other than I would say some form of cybersecurity is probably going to be something that we least understand. So I'm not worried about Russia. I'm worried about ISIS, but I worry about things that I can't contain and control, and that's cybersecurity. We're all interconnected now. We have no idea how to truly protect our information, and so we spend gobs of money to try to protect ourselves. Our technology teams tell us we're underspending all the time. And they raise your paranoia too. But just the notion that we're all utilizing the same global pipes allows really the entrance of some seriously bad behaviors. And when you go to China, I have to go to China now and bring a phone that is just a phone. I cannot bring any data into China. I learned the hard way because I was there one time when everything was I went to another country and I couldn't use my phone because it was still locked in China. And you're being watched, but it could be in many other countries. So this is more the unknown. I'm a pretty strong rationalist and I don't think problems are mitigated. That's the beauty of humanity. When you know the severity of the problem, and problems can get much worse before they get better, but humanity does a pretty good job of self-correcting. I actually believe one of the reasons why the oil market is pummeling right now is because the Saudis have totally changed their behavior in the last 2 weeks. Historically, Saudi is the global valve that adds or subtracts production, and they use $100 oil as a barometer. This is the first time in tens of years that they have not changed their production. When oil broke 90, and now it's at West crude is below 80, and I think they're doing this to destabilize Russia and Iran. And so again, another self-correcting thing that no one talks about. But so, as I said, so I'm not as worried. The problem is if Russia is more aberrant than we think, they're in deep trouble right now. At the IMF, BlackRock hosted a dinner for 25 governors of central banks, and the governor of Poland loudly said, Russia needs Poland more than Poland needs them, and because where oil prices and the sanctions, they're in deep trouble, and so they're going to have to provide natural gas to Europe, or the economy will just collapse. Now, the other thing the Polish minister said, Russia has more Stockholm syndrome than any nation in the world. They could take more pain as a result of it, and so that's why you could see more aberrant behavior.
Let's talk a little bit about, given all your observations, where would a high net worth individual, a more sophisticated family office, CIO, endowment foundation, where would they be looking for investments, given what's happened? I was listening on the radio on the way in this morning. all of the talking heads about the interest rate environment and how what we thought was going to be closer to normalization 2 weeks ago looks pretty scary this week. They were saying that if you wanted to know where interest rates are going, you would look at the 10 years of the most developed markets in the world and take an average of those, and that comes in somewhere between 1.5 and 1.62%, which is where the 10-year Treasury might go. What do you surmise about interest rates, and where should these people be looking for investments?
Well, the markets are telling you that the world's going to become Japan. Or maybe the world is telling you that central bank behaviors absorb so much assets that for the private sector to get anything, we're running after the crumbs. Probably a combination of both. I see no long-term opportunities in the entire bond market at these interest rates. People run after bonds because they're frightened. It doesn't mean it's a good investment. They're frightened. No different why New York City real estate has gone crazy. That's Chinese. They don't care about earning a return. They care about preserving their capital. So you're seeing some very weird behaviors that are transforming global markets, whether it's the London real estate market, the U.S., Toronto, I could go on and on. But you're seeing foreigners coming into these markets just buying real estate at stupid prices. And for them, it's not stupid. It's just they have a whole different motivation, and that's preservation of capital and trying to, and that's just becoming more. It's louder and louder. Look, if you look at what's gone on to our bank, the amount of leverage in the United States, leverage has collapsed in the United States, except obviously in some of the hedge funds. But it's certainly the consumer balance sheets have improved. You look at leverage. Banks in Europe are still deleveraging, and so there is actually a shortage of good investable assets in fixed income. And if the ECB does buy its $500 to $1 trillion of ABS, you're going to see the credit curve now collapse. But for any long-term investor, wealthy or poor, to me at these levels right now, without any hesitation, equities are the place to be. And there's some great values here. I mean, the pessimism in the world is so great, and we all left Washington at the IMF just outright bearish, and that's one of the causes of the markets failing this week. $80 oil is a massive tax cut for the world. The governor of Bank of India told me if oil prices stay below 90, it's a 1% increase in GDP for India alone. I think, the pessimism is just overwhelming, but we believe if oil stays here, it's fantastic for the emerging markets, other than those who are commodity-based. Many aren't. The Indias, the Chinese, and Japan. It's fantastic for Japan. It's great for the American consumer going into the Christmas season. I mean, you look at all the retailers; they've been battered. Probably a good place to be in the short run. And then for Europe, this is very good for Europe. What we need. So despite where interest rates are and the fear of the world, I strongly believe the Fed has to begin raising rates as soon as possible, because the world needs a more expensive dollar. And if for Europe to restabilize itself, they have, if Draghi gets approval to do his bond purchasing, if the AQR, we believe, and we've heard that we're involved in a lot of them, they're not going to be as bad as the world fears, especially in the large banks. If you have a weakening euro, and now with oil prices down where they are, even related to the dollar, because oil prices are down much more than the dollar. And so it's very positive for Europe, too. Or the increase in the dollar value. So I'd be in equities.
I'll shorten it up. I mean, I think that, number one, your question was about, I think, for wealthy individuals, family office types. And, I used to, my moniker for this is one I still like, is that people become wealthy by having a concentrated investment, and people stay wealthy for long periods of time by having a diversified approach to investing. I think now I certainly would be diversified, and I agree with Larry that a tilt towards equity-oriented investments, and that can be private equity, it can be public securities, it can be certain places in the real estate industry. So I think you'd want to have some type of equity-type investments. And if you're a long-term investor and there's a premium for providing long-term capital, in other words, you're being paid to be illiquid, then you should be a buyer of that premium, in my mind, if that fits with the term structure of your investment horizon. I think, too, that Europe is kind of an interesting one. The benefit from lower energy prices is a positive and might tilt me to being a bit more positive than I was 6 months ago on Europe, just because of that. But I think what Larry said about bonds, the world is uneven in their approach to their growth issues. And the United States is probably the furthest along in applying healing salve to the economy. And the UK is next, and the rest of the world is behind. So if I had to guess, and Larry, you know more than me, not might, I think you'll see the U.S. be the first person who's got the ability to try to bump rates a bit. And so if I were guessing, and again, I don't feel as though I'm an expert, I would suggest that if one had the mindset that 2015 in the U.S. will be the first place in which you see some real effort to bump rates, would be my best guess. And then following with the UK, and then maybe Western Europe past that, and we'll watch Mr. Draghi to see. But he's got some work to do before he can even start to think about that, would be my take. We haven't rehearsed, so you can...
One more question from me, and then we'll open this up for some additional audience questions. You both have played such a prominent leadership role in world-class firms over your career. What do you think are the keys to building a high-performing, durable investment management culture? There's been lots of discussion about tone at the top and whether investment management firms is it lip service, or is there great change going on at the top of most of these firms?
I'll start this one and then throw it to Larry. I mean, I think that these are professional service organizations, and so therefore they're about people and they're about culture. And it's really not a lot more complicated than that. And I think this is true for all the really good professional services organizations. And one of your recent speakers is Charlie Ellis, who wrote a book about this, and he picked 4 or 5 different companies from different industries, a consulting firm, a law firm, a securities firm, and he talked about each of them. And I think it really came through that in all of his examples, whether it was Cravath or Goldman or McKinsey, and he had others, that really it's about deciding that people are your most important pursuit, not a single piece of business, great people, and then creating a culture that people like. I've always felt that people stay and do well at companies for 3 reasons. Number 1, they're doing a job they like and are excited about. Number 2, they like with whom they work and they're proud of where they work. And number 3, they're paid fairly. And lots of organizations think about managing talent in the reverse order. What do I have to pay them? That's the 3rd thing. If they're doing work they like, and they like with whom they work and they're proud of where they work, then the compensation becomes a pretty easy conversation. And I think it's really a cancer in an organization if those things get reversed. And so you have to think about it all the time. And then there are other issues, strategy, execution, but treating people right and getting good people there is really the right thing.
A corrupt firm can corrupt even good people. So it comes down to culture of a firm and the relentless pursuit of a common culture with strong principles. I do believe it starts at the top, and if the leadership doesn't exhibit the strong cultural and principles, It's very hard for an organization to have that. What makes it more troublesome, and whether it's any large institution, globalization makes it much harder to build a culture worldwide. And so it requires even a bigger effort. But it comes down, in my mind, it comes down to a strong base culture. It comes down to investing in technology. So if you are global, excuse me, I don't even know who that is, 718. If you have a global firm or in multiple products, a strong culture has to be connected to one pipe. Most firms, a lot of financial firms that have blown themselves up, is whether through acquisitions or just expansion in businesses, had multiple pipes. So they had no risk management, or they had no way of executing a strong culture. So for us, and we've always believed that it comes to culture first, strong technology, and then obviously it's as Bob said, it's all about the people. And there are some really crummy companies out there, and it's generally because it's not a strong culture, or they have not invested in the way to link everybody together. And that has to be done through technology and intersection and all that. So, and I do believe the problem of financial services industry has, in some cases, have been weak in culture, in some cases, and weak in technology. The great firms have proven that they have built a great culture over many cycles, over many generations, and have done it through the investing in technology as they build out their enterprise. Asset managers, we are going to have a big consolidation, because with globalization, with higher regulation, it's going to be very hard. It's going to be very hard for, I have a hard time understanding how a Greenwich, Connecticut, since we're here I'm talking about it, a Greenwich, Connecticut organization that's investing in Chinese stocks, unless they have enterprise in China. And yet we continue to think people can do things like that. So I do believe we're going to go through a whole change in thought process and what is considered a fiduciary standard for investment firms.
Thank you both very much. It's such a unique opportunity to have these two people here. I want to give you plenty of time to say what's on your mind. And so without further ado, we'll open up for questions. I don't know, is this like a presidential conference where the person that blurts it out the loudest and first talks, or how do you want to do it?
Or raise a hand.
Raise a hand. I know Carol had a question.
You spoke to how, whether it's family offices or endowments, should be positioned in the current environment. For those institutions that are managing against liabilities, be it an insurance company, what would you suggest to them?
We did a modest survey recently, and we did it at the CEO levels, talking to a bunch of insurance company CEOs and some of the largest bank CEOs. The question was, what would be more damaging for your enterprise if interest rates remain where they are for the next 2 years, or if interest rates are up 3% in the next 2 years? And it was 6-0 if interest rates stayed the same. That'll be much more damaging. I actually believe interest rates right now at this low is going to start now restricting capital, and I think insurance companies and banks will start lending less, because the risk reward today with these low interest rates, especially for insurance companies, to write annuities here, and so what's going on, and you're starting to see that in some of the bank earnings, their margins are starting to constrict and constrict and constrict. I actually believe we haven't seen nothing yet. If we stay at interest rates at these levels for the next year, because so many banks have repeatedly underinvested their assets versus their liabilities. And that's another reason why we're seeing this big run-up. That you had that fear factor from a lot of these institutions. Look at it. I mean, we're the largest outside manager of liability-based investing, so we do a lot of that. It really depends on the risk appetite. This is one of the big reasons why high yield is where it is and why real estate is where it is, because insurance companies can't make the necessary return versus their liabilities. We're seeing more and more insurance companies add, despite the capital standards, more in equities, more in dividend-based equities. But there's no one answer for a wealth management office or an insurance company with fixed liabilities. It really depends on the risk appetite and the horizons that you're willing to accept. One of my greatest meetings in my life was with the Emir of Abu Dhabi. You know, if you think about ADIA, ADIC, and Mubadala, those are the three sovereign wealth funds of Abu Dhabi, it's probably $1.2 trillion. And that's a family office. Okay? We all call it a sovereign wealth fund. No, it's a family office. There's just three of them. So $1.2 trillion family office. Pretty good. So during dinner, I asked him, what is your objectives? And he was pretty philosophical about, 20 years, 40 years, we may not need hydrocarbons. And so we need to build the largest nest egg for our society, multi-generational. Sounded pretty good. So I said, so how do you measure that? He said, quarterly. And so that's... So it's there's not one answer, because depending on your horizons, that your real horizons, not your stated horizons, but what horizon can you live with? Do you have a board that will be can you have an investment policy that is very different than your peers, that your board would accept that you may have big variances between how you invest and versus other ones? I mean, I sit on 3 or 4 investment committees of some endowments, and I get pissed off every time we look at, how did this endowment do versus us? I mean, who cares if you're meeting your liability? And so getting back to your answer is, if you have a long horizon, you can then invest in things that have long horizon outcomes. The one thing that I will be recommending heavily is there's going to be a massive amount of capital invested in, or opportunity for capital to invest in infrastructure. I think that will be one of the great investments for long horizon investments. We will be announcing some rather large investments in a couple of the in Mexico and a few other countries in the next few months. That it's all long dated horizon, high coupon type of products, and that's what we think people should be investing in, who are more in with fixed liabilities.
Well, please.
Thanks. Both of you spent some time talking about banks and deposit institutions as it relates to regulation and how they may evolve. I was curious about 2 other parts of the name. First being the investment banks and brokerage firms. Both have worked with them in the past, they're counterparties, but neither are in that business today. So
thank God.
So what's your view on those? Maybe that shared it already. And then the other is in the alternative asset management space, which is an area you're both in a big way in terms of how that's going to evolve.
So investment bank and securities businesses, they've basically been tagged with most of the characteristics from a regulatory perspective as depository institutions. Mm-hmm. And I never, ever thought I would be part of that. And I could think of, before the Bear Stearns weekend, I could have made a list of 100 securities firms that had left the industry during my career. And on that weekend, and Larry and I spoke a lot of times, and when we used taxpayer money to basically facilitate the acquisition of J.P. Morgan by Bear Stearns, we basically crossed a bridge, in my opinion, that basically connected them in a way that wasn't the preferred public policy, but it was the preferred solution in a specific time. So I think the reality is that a lot of the issues I described when I was describing depository institutions, I think affect the large securities investment banking firms. I was reading the Goldman proxy, and I was reading that bonus payouts are paid full at 12% ROE. I think if we'd ever had 12% ROE, I'd have been too embarrassed to take a bonus. That these are the return ambition is just different, and the requirements.
You didn't have the capital that they demand now.
And what I was going to say was today you have two forces: one, more capital, and two, you've got to get out of the good businesses, the better businesses that provide the higher rates of return. What I would have viewed as good businesses in our day. So I think the cocktail of events around them are not attractive. Asset alternatives, I wish I had a better word for that because it's a bit soft, but I know exactly what you mean, and we are in that business, and that's been a big push for us. I'm a believer. And I also believe I like the private format because it allows for more value to be added by the manager in some ways. Larry has a huge business in public securities. I don't. But I can think of 2 or 3 products where I'm just not optimistic that buying a security at 72 and selling it at 82 is a sustainable advantage you can build over time. I like the idea of getting involved in companies, making them better, platforming, adjusting course management once you're in the middle of it. And I think that's a way where I'm pretty optimistic that you can make things better and create value. So I like that space, generally speaking. And it's a modest part of the asset investments, but it's one that I find attractive.
I'm not going to get into the alternative space because I want to emphasize this whole issue of the change in the role of the broker-dealer. Regulators truly are finding every way they can to have banks who own broker-dealers to minimize that business. The Vicar rule in the UK is going to demand all your retail deposits are going to be cordoned off, and you can't use that for any of your wholesale businesses. You have liquidity rules. You have the Volcker rule here that is going to be inhibiting market making. And so Bob said it very clearly. It's going to be a harder business for many institutions, which means those institutions who are going to be in it, they're going to make a fortune, by the way, because there's going to still be a need for market making. The greatest risk we have, and I think this is, in the short run, probably the greatest risk we have, and we saw evidence of this yesterday, and this is why the regulators all were calling me yesterday, is liquidity and the lack of liquidity in the marketplaces. And this is probably the number one thing they're focusing on now because of all the regulatory issues now. They're now focusing on the liquidity issues. I keep on telling them, you guys created this,
Exactly.
but they don't like hearing that. But nevertheless, there is a great need for regulators to force into the capital markets greater movement towards electronic markets. Actually, the street is inhibiting that because they're making actually a lot of money in the corporate bond market now. Bid-ask spreads are wide and all that stuff. It's very good. But yesterday's actions, this morning's actions in Europe is going to probably force more regulatory issues related to the acceleration of electronic markets and creating better liquidity. All by that will actually then reduce more and more profits of the broker-dealer. And that's why broker-dealers are fighting this. So behind the scenes, they have all these restrictions, but they're still making tons of money in the opaque bond markets. And so this is one of the structural issues that we're seeing live in color right now, that we've had regulatory changes changing the behavior of these banks, and yet we're not changing their behavior fast enough, and they don't have any incentives to create more electronic marketplaces for bonds. And this is one of the reasons why, why some hedge funds are having a real hard time. You just don't, and Bob kind of said it, it's very hard now with the high transaction costs to making money, and it's going to get harder and harder. And this is why those alternative investors who have long horizons, whether it is private equity, there's some hedge fund managers or some products that have long horizons, or long horizon products, as I said, like infrastructure. I believe that's where I would be placing my money. I would be less focused on. I'd be less focused on short horizon investing patterns, especially with a lot of the hedge funds. And then on the fixed income space, I would, especially with where interest rates are, I would run out of any bond position you have that is based on an index because of the convexity and duration issues, and I would run more and more to unconstrained products where you're not tethered to a liability that most probably is going to hurt you economically in the next few years as rates rise.
One of my biggest fears is extrajudicial government actions against banks and businesses, where you have unlimited fines, legal defense against government actions running to hundreds of millions or more, and jail time. Can you gentlemen comment on that, particularly as it relates to banks?
My word I used earlier is, I think, encompasses everything you just said. It's the spirit of retribution. And if you don't think it's out there, then, go to Main Street, not in Greenwich, but in Bridgeport, and ask 100 people how they feel about big financial institutions and what they should do to those guys. And I think that, and politicians directly respond to the feeling of the public. They're no, it's the idea that there'll be original thought or courage by politicians is not a good bet. And they're basically just responding to the feeling in the street. And that hasn't been requited yet. That's out there. And I might not think it's right or whatever. My personal experience is this was that when we worked at Treasury and we basically came to the conclusion after considering lots of things, and Larry and I talked about this a lot, that TARP was the best policy for stabilizing the economy and the financial system by pushing capital to the large institutions. We decided that. We thought about lots of other things. And when they polled, TARP was slightly less popular than terror. And I don't think that's changed since 2008. And that basically that the TARP, anti-TARP sentiment, which I put all this in that bucket, is still out there. And politicians have no interest in requiting that because they can.
So this issue is something that totally pisses me off, and I'm being generous right now. As a co-president of the New York City Partnership, I spoke to de Blasio, Cuomo, Dudley, Stan Fisher, Jack Lew, Jeff Zients. Everything Bob said was 100% correct. But one would hope that the politicians would see above this. So we ask ourselves why we have such short-term behaviors. It starts with the politicians just as much as anybody. To that person in Bridgeport, when they see a bank being fined $12 billion, $12 billion is a lot of money to them. Therefore, if somebody's fined $12 billion, they probably are evil. So it creates a negative feedback loop. And I'm stunned that we don't have somebody standing up and understanding that, and yet they're just using this for, the congressman in Bridgeport is just using that as a mechanism to get reelected every 2 years.
And the thing that really, to borrow Larry's word, pisses me off is that it also, I think, has a dampening effect on the economy. Absolutely. So that there are less jobs and less people doing better because of it. And, that's really wrong. And the idea that this is seen as progressive vocabulary actually has a regressive effect. And so it really pisses me off, to borrow his phrase.
And that's what I told de Blasio and Cuomo. I believe we're going to lose tens of thousands of jobs from foreign banks saying, I don't need to be in this place anymore. I could trade dollar-based assets from London, Paris, Frankfurt. I don't need to be under this jurisdiction anymore. And I do believe we're going to see a wholesale amount of jobs moving out of here. And it's going to be, as I said, the UBSs and everybody. And I've talked to 3 chairmen, and that is their long-term plan, to slowly evolve and slowly not replace jobs in the United States and move them back.
Let me just ask you this quickly, because I think what's playing in Bridgeport is they'll see the $12 billion settlement, but the question I think a lot of people in this country have is why haven't any senior individuals that were involved in the behaviors why is that an issue, do you think?
Yeah, it's called, we need tort reform, we need legal reform. In Europe, if you look at Europe's actions, they don't destroy institutions, they put people in jail. In the United States, we're incapable of, or we've had a poor history of putting the actors in jail who were bad actors and trying to preserve jobs in the institution. And they try to make it systemic. And if you look how the Justice Department and all the regulatory things, they are now asserting things, criminally, which they never did before. They are asserting more definitional charges of fraud at the company level, and there is they can't see they can't even determine whether it's systemic or not. They're just using those words, putting a gun to your head and saying, give me $12 billion. I will tell you, this is one of the future problems we're having, and there's another complaint I have in Washington, is you're seeing regulatory football. Right now, my fear is the SEC feels like they've been left behind, and so their supervisional issues and penalty charges and assertions are being ramped up, and they're now, I'm not saying they're going to be rivaling our Justice Department, but you're going to see some more and more settlements with more and more money from the SEC. You're going to see more assertions of fraud from the SEC that are in many cases are trivial, but they're asserting that to get more financial penalties, and that's our legal system, and you could blame it on the American Bar Association that has allowed this to happen. And I mean, so one little statement, and I got to get going back to New York, but at BlackRock in the last 4 years. We now have 400 lawyers, I think up from 200 lawyers, and I think we added more than 100 compliance officers in the last year. And this is what regulators demand from us.
We have time for one more question?
And I got to go.
That's it? Please.
Could you talk about oil? You mentioned that if oil prices continue to stabilize or further, you use that conditional word. Could you comment on where you think oil prices might go?
I've been a long-term bearer of oil for years and years. I mean, I never understood, the technology that we've created to extract hydrocarbons is amazing. What's going on in Mexico with all the reforms, Mexico has the potential as much hydrocarbons as we do. I was told by the oil minister in 2008 of Saudi Arabia that Iraq has more oil than Saudi. At that time, Iraq was producing 2 million barrels a day, Saudi at 9 or 10, depending on the moment. Mm-hmm. And they just said if this was ever a secure place, which obviously right now doesn't look so secure, but ISIS is not near all the major oil fields. So actually, Iraqi oil is up to about 3.5, I think, right now. So there's a lot of hydrocarbons around, and as we continue to build out more efficient vehicles, and we're using natural gas more as another mechanism to fuel our fleet of trucks or heat our homes, and I think the long-term tendency is for oil to be lower than it was systematically years ago. But look, if you believe in global growth, you're going to have great needs for more hydrocarbons. And right now, keep in mind, as everyone will tell you, any oil trader, the movement of oil is really the last mile, because it's just that marginal need for oil, and it moves the entire market. But I like what the Saudi oil minister told me. $100 is parity, and $120. They always told us that it will create a huge expansion in alternative energy at $120, and at $80, Iran, Russia, a lot of the oil extraction companies that we've created here in the last few years become pretty unprofitable. I mean, if we stay at these levels, I would think a lot of the money that people put into these exploratory companies in the United States, they're probably going to be pretty stressed, if not totally flatlined. So, you could argue if Saudi for a year and a half wants to keep oil at $80, it's going to create a lot of problems for those who are the last entrants into the oil market, and it would have some geopolitical issues that, from their perspective, may be good, and even for our perspective, may be very good. So I'm actually relaxed about it. What I'm not relaxed about, or what I'm surprised at, in all my 38 years of being in the investment markets, low oil prices is really good for the economies, and if you read the narrative today, it's like a problem. This is damn good, and this is a huge opportunity. As I said earlier, it's a massive global tax cut.
If 100 has been par in the last decade, at some point in the decade ahead, par won't be 100.
Yeah.
It'll be something less than 100.
Yeah.
But it'll be something like 80, and I think Saudi Arabia controls the valve, and there'll be a decision made someplace as to what the new par is, but it will be lower, but not dramatically lower.
Thank you so very much. It was very informative. I'm feeling a little calmer. I haven't looked at the market in the last hour, but I'm feeling a little calmer. Thank you so much for being here.
Yes, thank you. Look at
Just one thing, we will be meeting here on November 23rd, 20th, okay, for the great rotation. And I got to run. Thank you, Larry. And I want to just mention we are publishing best practices for investment committees going, I think, next week, that is. So, again, and I want to thank Brian Furtado, who has been in the background providing us with these speakers all these years. Brian, thank you very much. And thank you, Bob, and thank you, Larry.